Mark Matthews, Head of Research Asia at Bank Julius Baer. Mark, hi, morning. You have a neutral stance on India. What are the key trends that you're monitoring? Elections and policy hurdles, are they an important factor according to you? And what, according to you, would make you change your position?
The key trends in India are the trade deficit, the current account deficit, and the rupee, and of course they're all interlinked. And the fact that the deficit remains at about $12 billion per month is what puts pressure on the currency. I don't see what the RBI can do. Their forex reserves are limited. But I think the ironic twist is that with the fall in the currency, exports are rising very quickly. They were up 12% in July, whereas the imports were down 6%. So ironically, that should improve the trade account over time, and therefore it should stop the rupee from falling a lot more than it already has.
Right. Matthew, so what is the growth expectation from India or from the Indian economy for FY14 and 15, and how does it compare to rest of EM basket?
I think right now the consensus is looking for about 5 to 5.5% for fiscal year 14, and then about 5.5, 6 to 6.5% for fiscal year 15. And I think that's probably not realistic because we haven't seen any pickup in investment. And even so, it takes about 12 to 18 months for investment to spill over into GDP growth. And so in the absence of any investment, I think that those numbers are too high.
The funding requirement for the economy are growing even as money supply tightens. What did you make of the government's measures to allow quasi-government companies to access about 48,000 crores of tax-free bonds?
It's clearly a good move, but I don't think it's sufficient. Maybe I would say $5 billion at most is what they would raise for those big oil companies. And when you contrast that, as I said, to the deficit of about $12 billion a month, it's not large enough to plug the hole. But I do think that what is interesting, since you mentioned it, is the sovereign wealth funds, because India, I think its great appeal is the fact that it is a non-commodity emerging market, and there aren't many of those. And so most of these sovereign wealth companies are commodities related, and they want to invest in non-commodities countries with a lot of growth. And so I do think the longer term, India does look interesting for these sovereign wealth companies.
Do you see the bond market being rupee supportive as well? And are you anticipating more measures from the finance ministry as well to really defend the currency?
Well, once again, I think that relates to the new governor coming in next month in the Reserve Bank of India, because he has very close ties with the finance ministry, and he is very highly regarded for his international expertise and his good track record. So although I can't think off the top of my head what he could do, given the limited foreign exchange reserves of the central bank, he might be able to pull a rabbit out of the hat in conjunction with the Ministry of Finance to stop the hemorrhaging in the rupee. But as I said earlier, I think that the strong trend in exports, which should continue because there's more momentum in global growth than there is in Indian growth, means that the rupee downside shouldn't be much more from here.
So for the global investor looking at emerging markets and India, what portfolio allocation would you recommend?
Well, we as a house like equities over fixed income, and within the equity space we like developed markets over emerging markets. So clearly India is an emerging market, but as I said, there is something unique about India, which is that it is not a commodity play. Brazil is, Russia is, in large part they are. So India has these headwinds. As I said, the growth is probably overstated that the consensus is expecting. It doesn't look particularly good now, so we do have a preference for the developed countries.
Right, so within the Indian markets, which are some of the big sectors to your mind which offer the best risk-reward ratio, and what would you advise one should avoid at the current juncture when it comes to Indian equities?
Well, clearly the sector that has done well is the export sector because of the currency weakness. And I think even if the currency stops depreciating from here, as I said earlier, there's more momentum in global growth than there is in Indian growth. And so on balance, putting those two together, one would expect export-related companies to continue to outperform. Doesn't mean IT exclusively, but that's part of it. And then in terms of avoidance, I think the financial sector has revealed rising non-performing loans, and I don't think that trend has completed itself. So that would be an avoid.
Is the banking system in India worrying you right now? And because we've seen slippages, restructured assets rising quarter after quarter, are we sitting on a ticking time bomb here?
No, I don't think so, but I do think that the reason why these NPLs are rising is because growth has been slowing, and I think the growth will not go down to a very, very low rate, but if it hovers around this sort of 5% rate, then probably we'll see continued rise in the NPLs, but not a time bomb.
Matthew, give us a sense of what you're tracking when it comes to the global economic data. Japanese Q2 numbers, I beg your pardon, were disappointing to say the least. Chinese production trade numbers have been lower for a while, whereas US consumer is clearly moving from strength to strength.
Well, I like Japan. I agree that 2Q GDP was disappointing, but I'm willing to look beyond it. I still give Japan the benefit of the doubt. I think that there are big changes afoot there which will result in an improved economy. China, you're right. The numbers, continue to be weak. I see no real reason for that to reverse, given this new leadership has very clearly stated mandate to control corruption and try to create more equality of wealth distribution. And then your last point on the U.S., I agree with that. I think the U.S. Continues to recover at a modest rate and should also continue to outperform.
So what about the inevitable quantitative easing 3 withdrawal? How does that one tackle the pullout?
Well, I think the Fed has done a masterful job at making us aware of this impending, very important inflection point in policy. And why do I say it's masterful? Because, in fact, the Treasury yields remain quite low, and the stock market is close to an all-time high. When they do it, whether it's September or sometime later this year, I'm not sure if it makes that much difference. The fact is they've given us a signal that they're going to do it. The million-dollar question is, where do those Treasury yields go? And I think given the rate of the recovery, which is still fairly pedestrian, that we should not see the 10-year Treasury materially above 3%. And as long as it stays below 5%, then I think we'll see continued upward movement in stocks in the United States.
Okay, Mark, appreciate your time. Thank you for joining us.